Hey, what's up, everybody? Hey, what's going on? My name's Russ. I'm out here in Chicago, Dapper Dividend's YouTube channel. We're going to talk a little bit about Apple. Now we're going to talk about the Bears and moving out to Arlington Heights. So what's going on? This actually stems from a little bit of a thing I ran into on Twitter where all I did was say, hey, this is something interesting. I was looking at Apple. I've been, learning my financial analysis and improving it, sharpening those skills. Did I say improving? Improving my skills, and ran into this interesting thing from Apple. And all I was saying is, as investors, what I think is a prudent thing to do is to look for holes to punch in a company, why they may falter in the future, problems that they may run into. It doesn't really help to only look for the great things. Kind of like you want to, instead of only investing in the winners, is also try and look to avoid the losers, right? And that'll kind of maybe help sort some things out. So to get into it, this is what, oh, by the way, click the link below. I should have it for my newsletter, my landing page, if you'd like to sign up for that. But here we go. So with Apple, one thing that it's a great company. Don't get me wrong. Apple is a fantastic beast of a company, but this is just something you should know about. All I'm saying, just this is something you should know about when you are an investor in Apple. And if you're like me and you invest into mutual funds, Apple's a big part of a lot of mutual funds. So this is one thing that we need to watch about. Okay, here we go. So this is from Annual's latest Apple. This is from Apple's latest annual report, which came out in September of 2022. And let me get this a little bit bigger here. So one thing to be concerned about, this right here, their net sales by category. This is all the money coming in the door. This doesn't include yet the cost to produce the goods or anything like that. Just the dollars coming in the door, the sales or the revenue. So the iPhone just crushing all of their other categories, 205 billion, 191 billion in 2021. So we see it was an increase of 7% for the iPhone. Obviously, the Mac was up 14%. iPad actually down 8% year over year. And the services were also up a big 14%. So kind of an interesting thing that the iPhone makes up a huge portion of Apple's revenue, and you can see that it has been included. So I'm reading the comments here. I just wanted to make sure never had a product. Okay, cool. So check this out. Now, this is an interesting pie chart. It's 52%. This is from 2021. Obviously, what we were just pretty much looking at. All I'm saying is if you're going to invest in Apple, I think that it's something noteworthy that over half of their revenue comes from one product, and that one product is a phone. And I made the comparison, probably not a good apple to apples comparison here, but apples to Blackberries. I compared it to the Blackberry, which I remember the Crackberry. Dude, everybody was all on that Crackberry, from the top down, from businesses to presidents to everyone had that Blackberry, but it ended up faltering. Now, they didn't have the ecosystem that Apple has. They didn't have the cult-like following, but something to be aware of there. And then one reason I think it's important is because there's a lot of different guesstimations out there about how long it takes people to replace phones. And I'd love to know in the chat below, how long has it been since you have replaced your cell phone? For me, my work provides mine. It is an Apple, and I switched companies, but it's years. It's not that often that we get new phones. So check this out from Strategy Analytics. They're showing that by 2027, it should be about 40 months on average for the global phone replacement cycle. And we see that it has just been getting longer and longer and up since 2013. So just something to keep top of mind or back of mind if you invest in Apple. And I'd love to know if you think this is any of a bit of a concern to you. And then I also found this from everphone.com blog. where they show that an iPhone is usually replaced every 4 to 8 years, which is consequently longer than all the other Samsung, Huawei, the other two I've never even heard of, but maybe that's because they're pieces of junk and they break quickly or quicker, or they're cheaper, so they're easier to replace. But hey, good morning, Kevin Mendoza. What's up, man? Thanks for hanging out and checking that. So anyway, that's all I'm saying. Really interesting thing. And then I want to take a quick peek at some Apple's numbers, and we will end it with the intrinsic valuation of good old Apple. So Apple on Simply Safe, and I like Simply Safe. It makes it easy. I have another really cool tool we're going to jump on, and I'm going to show you in Alpha Spread. But as far as Apple, dude, beast of a company. I'm not knocking them in any way, shape, or form. All I'm saying is 52% of their revenue comes from one thing, and that one thing is a phone. But 99 dividend safety score, they're $149.70 a share. Just run through some of the metrics here really quick. Their recession sales, check that out, were up 14.4% during the 07-09 recession. So just really solid right there. 25% 10-year CAGR on the dividend. And you're going to see they're going to be able to increase this for as long as they can keep doing what they're doing. I won't say forever, because nothing is forever unless they're diamonds, right? Diamond hands going back to work at McDonald's with all the crypto crashing. Anyway, so we're going to be seeing diamond hands folks coming back to the McJobs. That'll be good for us as McDonald's shareholders. So 4.5% dividend increase last in April of 2022. So around my birthday, they should be increasing their next dividend. 10 years growth streak. Only paying 92 cents a share per quarter. Or I'm sorry, 92 cents a share annually, 23 cents per quarter. But if we look at some of the price valuations, this is not value. Remember, this is just price, and these are based on lagging data in the past. The dividend yield 5-year average is 0.97%, currently at 0.61 right now. So at least from that metric, it's not any kind of a bargain. And the PE is just about in line. Still paying $23.70 for every $1 of Apple's earnings. 149.70 is almost in the middle of the 52-week range. It got as low as $130. This payout ratio right here, let me make this slightly bigger. That free cash flow payout ratio, 13%. That is super low for Apple. And they're a healthy company. That's what I'm saying. Look at these numbers. Free cash flow per share, $6.87. Remember, they're paying 92 cents of that out in the form of a dividend, which, hard-hitting analysis here, is 13% of the free cash flow. So they can easily cover that dividend, no problem. And sales growth, 8% last. Coming out of the pandemic, we're at 33%. They're gonna be the first company to return $1 trillion to shareholders through buybacks and through dividends. And we can see here they are like gangbusters. They were at 26.1 billion shares outstanding. Now they're at 16.3. They buy back shares. And we'd want to see companies buying back more shares when the share prices are down, right? So during the whole tech wreck, this can be a good thing because they're getting their shares back at a cheaper price. So I think it's going to just only help Apple into the future. Total sales, again, $394 billion. Insane numbers. Return on invested capital and equity, just sky high. This is a phenomenal company. Operating margin, 30 cents. They're keeping 30 cents of every $1, and 23 cents of every dollar coming in the door is making its way to the bottom line as the free cash flow. Net debt, 62%, a little bit high for Apple. And that interest coverage ratio, which, I love that. That is the operating income. How much of that covers every $1 of interest expense? Currently $40.75 of operating income to cover every $1 of interest expense. So now for that's Nora, that is Simply Safe Dividends. Ticker SSD, I call it. It's not a ticker. Okay, so the intrinsic valuation, we're going to go over to Alpha Spread right here. Alpha Spread looking really cool. I guess hang with me for a minute. I guess we'll do a little bit of a live look-in demonstration here on this. I've just started using it this past week. 7-day free trial. I would, worst case, you can do the 7-day free trial, go through all your stocks, get some intrinsic values that they got, write them down, keep an eye on it. Obviously, things do change. We can chat about intrinsic value in a minute here, but they give Apple an intrinsic value of the base case of $124.67, which means it's overvalued about 17%. Now, this is the combination of two numbers, the relative value, which they kind of look at Apple and their peers and some of their metrics, and they have their own factoring in for this, plus the discounted cash flow value, which is looking out in this case 5 years and then discounting that cash flow back until today. Obviously, we're making guesses and we're projecting out, which is why they have best case, which is you want to stay away from best case. Don't look at that because that's the rosy picture. If you want to be safe, and yeah, Ryan, we'll look at SPHQ. Absolutely, man. So if you want to be safe, look always at either base case or the absolute safest is the worst case scenario, which they think is $100.99. But you can even go more safe than that and do the discounted cash flow value, which is $61.87. Now that is pretty low. That is the, great investors like Buffett, I think they do the worst case and they'll do like discounted cash flow in the worst case and buy 10% under that as their margin of safety. The closer you get to zero, the less risk you have of losing your money. Obviously, everything is risky. So those are the intrinsic valuations on Apple. But if you combine, again, the relative value and the discounted cash flow, according to Alpha Spread, $100.99 is a fantastic load up the boat, break the bank, break your wallet open. Anyway, so they have, I'm surprised with Alpha Spread, man. They have a ton of information. Really quickly, we'll go through some of them. They have their profitability score. They have a solvency score. They will show you their capital structure, everything, the total debt to, here, let's go down more. Their Wall Street target analyst. This is really nice, showing that the lowest Apple forecast is $123 from analysts. Again, these are people's opinion, $123. So that gives an 18% downside from here. And then, of course, their best case, you get these analysts that will do that. So, yeah. Oh, Caitlin, you're right. I just mentioned that on Twitter. Holy cow. People were not freaking out, but it literally was like dare questioning the cult. It's all I'm just like, hey. I'm like, hey, all I'm saying, 52% of their revenue comes from one thing. It's a phone. And people are like, this is crazy. You're crazy. But they show their competitive landscape. What else? Oh, this is cool. Their suppliers and customers. Interestingly, 109 suppliers come from China for Apple's products, which is interesting because Xi Jinping, I'm sorry, I have trouble saying this China guy's name, huh? That's more Brooklyn. He's dictator now. They're only supposed to do 2 5-year terms. He's into his 3rd 5-year term just because he's like, yeah, I like doing this president thing. So anyway, their second highest supplier is from China. Kind of nice to see these numbers, and they get supplies from all over the world, including Malta. What's up, Malta? Big shout out to Malta and customers. They also do that as well, showing U.S. and China are again at the top. And there you go. Their customers, they do, if you click on it, they will show their biggest customers in those areas and the United States. It's just all over the place. So this is really interesting that they go this deep. I was kind of surprised. And what else? Yeah, you can look at the annual price. I know we're turning this into an Alpha Spread, little bit of demonstration here, but there's a few other things. I'm just going to show you a lot of information about the company. They IPO'd December 12th, 1980. And let's see. Yeah, so these were at the top too. They have their valuations. Here's the discounted cash flow valuation. You can play around with it. Don't break it. Play around with it. Change it for yourself. They explain it. The model settings, the plus minus tabs here on the terminal growth. You can change it to yourself. Make it easy. I'm still on the fence about DCF. I understand it, but I'm still thinking you're projecting, you're guessing what the future is going to bring, which is why we want to do the best base and worst case scenarios as well. So to be safe like that, there you go. You click on worst case. They have a discount rate of 9.92%. KC, you probably have a lot to say about this. 5-year period, and the terminal growth rate is negative 3.83% in the worst case scenario. So this really can help us understand what a good buying price might be when we discount that cash back to today. And yeah, dude, there you go. It's just, this site surprisingly is really, this is just the DCF valuation section. I mean, the forecasted financials, you can see the growth charts. It's really something. And what I like is the financial statement. They do this for the three, obviously, for even here, revenue breakdown. It's just, there it is, the 52.1%. I didn't even see this earlier because this site, I'm still learning it. I'm still getting the hang of using it. But Alpha Spread, if you're looking for a new tool to play around with this weekend, I would highly recommend doing the free trial. Yeah, Steve, I'll look at Cisco in a second. Yeah, we'll pull up Cisco here for a second. But we could probably spend the whole hour just on Alpha Spread. But yeah, I like how they put it together. They have their earnings waterfall here showing you a lot of the stats that we need to know about these companies and the trends for the different segment, revenue, gross profit. I mean, it's really impressive. I'm very impressed with Alpha Spread. So before I just start looking at every little thing on there, Kevin, I saw your comment. You were so kind, buddy, to talk about Cisco. Let's see what they give Cisco really quick here for their, we won't look at all that. We'll just go in intrinsic value. So here we go. In the base case, combining the relative value and the discounted cash flow value, they say $48, which means it's about 7% undervalued. Some people like to do that 10% margin of safety. And in a worst case, we got $38.19, and the discounted cash flow value is $31.48. So, yeah, that's, I'll get to your comment in a minute, Casey, but it's a fun little tool I'm playing around with. And again, like I said, I'm, yeah, I see a Casey saying that Apple's overrated, but negative terminal growth projection is just silly. Right. So, but don't you agree if you do the negative, then that's the thing. Okay, look at this for Cisco, for instance, 31.48. I could see it getting there. And I will show you guys one thing that was undervalued. So this is actually one of the ways I found Celanese, doing some research, which I just bought and did that video on. But good old Burke B, Burke B, they have an, look at that. There they are. There's the guys. I'm reading a Buffett book right now. So did you know that Charles Munger had problems with his eyesight? He had cataracts, and the eye doc, the ophthalmologist, botched his surgery, and he was like, hey, it happens. It's in the minority, but I'm going to learn all about ophthalmology now. So that's one of the reasons that Charlie has had eye issues. But fantastic, dude. The power duo, that's, I don't know, Batman and Batman. I don't know if I'd say Batman and Robin, but last thing here, Berkshire. Their worst case, they got their discounted at 216. I don't think we'll see it get there, but 283.14. I was actually thinking, I don't own Berkshire outright. I might pick up a share just to hold it. We'll see. But funnily enough, I think Apple is their top holding, right? Oh, yeah. Why don't we do this? Watch this. If you guys want, you can just go to Google and type in Berkshire portfolio tracker. I didn't spell that right. It'll correct it. Thank you, Google. And right at the top, the CNBC. This is kind of a fun little thing. Oh, by the way, November 15th, a couple days from now, should be the 13F filing dropping from Berkshire. You're going to see a slew of YouTubers, including this guy. What has 2 thumbs and is going to do a Berkshire video? This guy. Why? Because I'm interested in it, and it probably should get some views. But they have a really cool interactive. Come on, you can do a computer. Come on. Stupid thing. Well, anyway, I guess maybe we'll wait for it to. While I'm waiting, I'll get to your comments here. While I'm waiting for the silly thing to. Of course, don't you love this? This is the beauty of being live. I'm like, hey everyone, check out this awesome portfolio tracker from CNBC, and then it's like we're looking at a blank screen, guy. Come on, guy, what are you doing? I don't know where it is. I feel like I'm crazy now because it's usually right here in this big empty white space. Well, we'll revisit that in a minute. So I guess hold that thought and let me chat with you guys. By the way, I pinned the comments to the right of my window so I can kind of chat with you guys while I'm going through whatever the content is that I'm sharing. Well, this is embarrassing. It's there. I don't know what the deal is, but heck with it. Anyway. Here we are. Hi, what's going on? So, yeah, what do you guys think? What do you guys think about Apple? Does that worry you with 52% of revenue? And again, you guys are so right. Just the mere fact that I said, hey, there's something a little noteworthy with Apple you should pay attention to, and it was just, I guess some people don't want the Kool-Aid they don't want anyone to tell them that it's a bad analogy. So yeah, they're what's up? Where are you guys from? If you want to tell me where you're from, what did you buy this week? What do you think about Apple? I mean, let's see. What do you want to ask me? Do you want me to get a discounted cash flow analysis, valuation on anything? And sorry, I'm still poking on that Buffett watch. This is the craziest thing, man. All right, so, well, we'll keep an eye on it. If it pops up, we'll jump back on. Ryan. Yeah, Ryan wanted to know about SPHQ. So SPHQ, I do not invest in, but I guess we can take a peek at it. And I don't know. I guess I'll look on. I guess I could bring you guys along with me. I could look on SP. Well, what do you want to know about it? Just what, like a good price? I don't think they do DCF for ETFs, if that's what you were wondering about, but it has a 1.65% yield. Here, I'll pull it up. Come along with me, everybody. Hello, everybody. Hi, Dr. Nick. That's an old Simpsons jam. Yeah, dude, I don't know why that's not coming up. Silly. I will just go right to the old SSD. To the SSD. To the SSD to look at the SPHQ, brah. Do your kids say, dear kids? You guys, some of you are kids. My kids, they can probably hear me. They were in a phase where they're saying, brah, bro. Anyway, 1.65% yield. Because it's, honestly, I've never looked at this, and I'm just realizing as people are probably like, dude, it's this SPY, it's this S&P 500. Yeah, so this is like a VOO, or I don't remember there's a slew of them. I know VOO and SPY. Those are the two main ones. But yeah, I guess I could start a fund and start tracking the S&P 500. They do have one. It's the Russ 2000, the Russ 2K, right? I should get a shirt with that. But yeah, it just tracks the S&P 500, 1.65% yield. And this isn't going to be anything too crazy. I don't know their expense ratio. I guess we should have looked up that. But yeah, it's just going to be average with the S&P 500. Not much else to say about that, really. I just realized what SPHQ was. I do like SCHD. That's the one that gets dividend investors all hot and bothered because of the 3.22% yield we got going on there and the dividend growth. 34% 10-year CAGR, 11% was their last dividend hike. I don't think they give the, you know where we would have to go for that? Let me bring you back. Let me make me big on the screen here. And here we go. That's what I'm looking for. Yeah, it's funny. Let me get to a few of these others, and then I'll bring up Seeking Alpha. Actually, let's see. See, I'm trying to speak and type and talk. You do this. You come on. You want to? Hey, who wants to come on? Who wants to jump on with me? I don't remember what I was doing now. It's a Sunday morning, man. What are you guys doing? What's going on? Let's see. I want to get to Casey's comment. SPHQ we did with Ryan Gochenauer. Ryan Gochenauer coming to us from parts unknown. And let's see. Yeah, I like so it's probably going to be Simply Safe Dividend, Seeking Alpha, and Alpha Spread. I'm really enjoying it. And again, I just started using it earlier in the week. I did find a discount code. I contacted the creator of it. So I'm going to try and get myself a affiliate set up because why not? I think I'm going to be using it for a while. I like everything centralized, and why not? You know, and there's a discount. So I used another YouTuber's. I found him doing a review of Alpha Spread, and he had a 10% coupon code. So I probably should have put that in the link. I don't know. Anyway, if you're interested, let me know, and I'll put it up, or somebody can find it. But you know what I want to do? I want to do this. So let me move my thing here down, and I can put some. Hey, by the way, let me fix this so I can do this properly. What's up, shipmate? This is Chris Cannell. He was in the Navy too. I didn't know him, but I was. Hey, myself, I'm a sailor. This is my boat right here. That's my boat. The USS John C. Stennis. Little bit of inside sailing for all y'all. I was in the bell-bottom Dungaree Navy, and we call our ships boats. Don't know why. Nobody ever referred to it as the ship, you know, but it was the boat. Going back to the boat, you staying on the boat tonight? You're going to eat on the boat? And let's see. Where'd Casey's? Here we go. Yeah, so she said negative terminal growth rate on a company with an invincible brand mode. I like that. Obsolescing. Let's focus and read the big word. Obsolescing hardware products, recurring services revenue, and some moonshots on the burner is not something I can agree to. Interesting. Yeah. Well, so that's funny. See? And this is stuff that you got to think about. Take it into consideration. So I think the thought, I just remembered what I wanted to say, is that when you see that worst case DCF value that they preset that. That's like their thing. It may never get there. And I know some people were saying Procter & Gamble. I won't put it up. Let me just pull it up here and see what they say for good old PG. We'll do the worst case, just their intrinsic value of the Procter & Gamble company. They give an intrinsic value base case of $96, but the DCF value for base is 89.5, which great point, Casey. I don't know if we're going to see a time when Procter & Gamble has a 5-year negative growth rate, but if they did, you know, that's interesting with the worst case. So, Casey, what do you use? Do you usually use the base case when you do your DCF analysis? I would love to know that. But Procter & Gamble is $96. So that's interesting. So they're saying if Procter & Gamble hits $96, you should be loading up. But that's the thing. When it got to the low 120s, dude, everybody was like, buy, freaking out buying. I was buying. So what do you do? What I'd like to know from you, say you don't own Procter & Gamble and you see that $96 and you want to wait for that. What if it never gets there? Then you just never buy. So that's something I struggle with. And that's why I did the PepsiCo 100 share a week challenge, because I think
PepsiCo is going to remain in demand. They're going to keep doing what they need to do to stay ahead of the game, to stay on top, king of the mountain. And I think that people are just going to keep buying them because they're a good company. I think they're going to keep increasing the value of the company. And I don't know if it would ever come down to that intrinsic value. So I just said, I'm going to buy one share a week. I don't care what the price is, how overvalued. And I was buying at $142. And I do remember people saying that it was overvalued. So let me pop this on here. I won't pop it. I'll just tell you. Or no, let's pop it on. Why not? Hold on. Come with me, everybody. Let's, I'm going to check out Pep real quick here. And let's see what we got. Share that. There you go. You should be able to see that now. Let me hide Casey's comment so you can look at that a little more. Okay. Sorry you had to see that. Here. So we'll bring up PepsiCo. Interesting because, yeah, so, yeah, dude, they own Cheetos. Come on. Everybody loves Cheetos and Doritos and Life Water and all the things they sell. $149.74. So this is really interesting because I distinctly remember buying Pepsi at, I think it was $142, and people were saying, dude, you're nuts. It's way overvalued. Over 140, it was like a new all-time high. They said this is way too much money. It has not gone back to there, and I wonder if it ever will. And I don't plan on ever selling Pepsi unless something crazy happens. But this is a concern I have, is that right there, I could see it hitting 149 again if we hit a really bad rough patch or people started dumping. But a discounted cash flow value of $108 they give as the DCF value. I don't know. I mean, it would take the COVID crash to get it down that low again. So I'll be curious to see if it ever goes that low. And we're still waiting on the Berkshire tracker. I don't know. Maybe it's broken. It's probably broken. We'll just say it's broken. Yeah. Finish up Casey's thoughts. Said they're overrated, but a negative terminal growth projection is just silly. And I guess I would have to agree with you. Oh, yeah. Nora, the Stock Explorer. You got to rhyme that. Nora, the Stock Explorer. That's how I want to say that. Yeah, Buffett is doesn't like crypto. You know why he doesn't like crypto? Because you can't put a valuation on it. It doesn't, and I believe, I may be speaking for the man. Warren Buffett also has a very famous quote, as we talked about on the podcast, where he said the coconut nut is a giant nut. And I say that Buffett said that, so he said it, okay? He didn't say that. But I don't know what I said now. See, I goof around. I forget what I'm saying, but that's okay. You like it? Thumbs up if you like a guy goofing around Sunday morning. So, yeah, with the FTX crash, it's just another exchange. I think it's the wild, wild west out there, and it's going to come to an end. I think most of the coins are going to go away. How do you value something that doesn't have any cash flow? I guess it's only a price, and the price is what people are willing to pay for it. So I guess they call that the greater fool theory, meaning if you buy it for $10, you're going to hope to sell it to somebody for more than $10 at some point in the future because it doesn't have any cash flow. And as long as people want it, then it's going to have value. So, yeah, with FTX, they're just a crypto exchange, like a stock exchange, like the New York Stock Exchange or the London Stock Exchange. It's just an exchange where people can go and exchange their cryptocurrencies for cash or other cryptocurrencies, and people store them there. But anyway, so FTX filed for bankruptcy. So we had Voyager, Celsius, another one I don't remember the name of, FTX. And it's really putting a lot of pressure on the crypto market. And, man, I guess you got to have those diamond hands at a time like this. So, yeah, Buffett is – I even said – I did a poll. Who do you think is going to live longer, Buffett or Bitcoin? And so far, I think the table's kind of shifting toward Big Buff Dog. And Steven is Team Android. Boy, we got the marble mouth this morning. You and my family, you bring up Apple, and I swear my father-in-law is like, Apple. It's just, I don't know why. He's not a fan. Most of my extended family is not fans of Apple. Cisco, Kreisen. Cisco is one of my favorites. I like Cisco. I like you, Cisco. You are my friend. I bought 100 shares of Cisco to sell covered calls, and it was part of that tech wreck where it's been down. Not as much as Intel, but I wanted it to be part of the wheel, but it's a company I'm okay holding, so I think they're going to be okay. And since you were so nice, Greisen, we will look for you at... let's look at Cisco. So as we're doing this, let's find that. And here comes Cisco. When I punch it in, I think they have a decent 91. They give them a safety score of 91. We already looked at their intrinsic value, but let's see the dividend safety. It's not what I wanted. Dividend growth. The dividend growth. 18% 10-year CAGR, slow 2% last. They have raised it 11 years, though. So 11 years of uninterrupted payments and increases. And their current yield is 14% above the 5-year average. So on that metric right there, again, remember, this is not valuation. When I look at these, like dividend yield and the PE ratio, the forward PE, that's a guess. Forward because I know people like to think they do, but nobody knows the future, which is what makes life so interesting, is not knowing what's going to happen. But these are price metrics. All these are price metrics. These don't tell you anything about valuation, in my opinion. So always take that with a grain of salt and know that these are backward-looking numbers, except for the forward PE, because people are trying to look forward, but that's a guess. So I think Cisco's going to be down with tech for a while, and 49% free cash flow payout ratio. Not that shabby. I like it. I told you I like Cisco. So yeah, Feiss Kreisen. Where are you from, Feiss? Fizz Grizzin? Oh, not like the Griswold Grizzins. Oh, if I would just read a little more from Sweden. My relatives are from Ederborg or Ederborg? Which one is right? Type 1 for Ederborg, 2 for Ederborg, and 3 for you have completely obliterated the name of this beautiful city. And let's see. Okay, let's see. She's figuring out some rebalancing for her portfolio. I don't know if you got to. Okay, there is. I did ask her. I do want to say something, Chris. It's interesting that you say this because I don't like Happy Veterans Day, because to me it's like a somber day. It's a day of remembrance for those unfortunate souls that lost their lives. And he was on a LHD, which is a troop transport, right? That did well. There was LHDs, LHAs, and LHSs, maybe. I don't know. I don't remember. Boot camp was a long time ago, Chris. For me, I graduated boot camp when we had to learn all that stuff in 1996. What stocks am I buying? I want to buy more realty income. I bought 13 shares at $64.75. I had enough to buy 200 shares when it was sub $60, and I just wanted it a little bit cheaper. So kind of kicking myself for that. That's one of my faults, is I get into that price anchoring. And I talked to KC about this. Dude, I get that price anchor and I'm like, okay, it was just at 58.75 and then it's at 60. I'm like, I'm going to wait for that 58. And then it goes up to 62 and I'm like, damn it. I'm like, all right, I'm going to wait for 60. And we're at 64. And I'm like, all right, 62.50. Come on. But that's one of my my problems. AT&T has 26.91 on alpha spread. That's interesting. And I'm guessing, Steve, that's their worst or base case, right? I mean, I could pop that up. If you want to see AT&T, that's a popular one. Let's jump on over there real quick. But I want to get to Casey's because I asked. And she said when she does her models, she does a base case. Okay, all events set to most probable outputs, reasonable bear case, plausible Murphy's Law spree, and reasonable bull case. Everything goes mostly right. I like that. That's interesting. And I don't know if I'm ever going to be on board with it, because for what I'm doing, and I understand, like Warren Buffett was like, dude, he would read 1 to 2,000 annual reports. He read annual reports and probably still does, like people read comic books. And I'm kind of getting into it. I'm kind of getting there, because you can really start to see some of the numbers, just like that little example I was showing you with Apple. And I think it's really cool. It's something I'm really enjoying, and I'm going to spend the rest of my life learning this and just being a better analyst, bringing better information. I really do enjoy it. I just really, truly enjoy it. So the point, though, is that what I did with Pepsi is, and this is probably my end around for DCF, to not have to like really sit down and figure it out, which is something I'm working on, but Alpha Spread is going to help with that. Is I said, I think 10, 20 years from now, PepsiCo is still going to be around. They're going to evolve. People are still going to be buying their products. They're going to still be a good, valuable company. So 20 years from now, even if I buy PepsiCo at quote unquote overvalued, it's still going to look like a good bargain, because good businesses are always going to be in demand. People are going to invest into good businesses. So it should always be in vogue. I don't know. Call me crazy, but making money is always going to be a thing, I think, unless we hit Bizarro World here. But what were we doing? Oh, yes. I do remember. I'm still waiting for the Hackshire Berkaway to come up. No, this guy didn't have alcohol for breakfast, so don't worry. Let me hide your comment, Casey, and then let's everybody come jump in the, I don't know, what do you want to call it? Jump in the old valuation machine, in the machine. And this is what we want to do. What were we doing? AT&T, right? Yeah, AT&T, man. AT&T, does it come up? No. I'm going to have to put the ampersand in there. Now you learn that that's called an ampersand. And see, look at that. They do it also on the London Stock Exchange. I don't know these, what XBR, FX, I don't know what those are, but we'll stick with the New York Stock Exchange. That's something I need to learn. Look at that. You can check out the price too up there. So they give them, like, Steve, I think you said $26.91 indeed for AT&T, and discounted cash flow value. So check that out. Just this, I think, again, I like the discounted cash flow number. I think it's a little bit more, not as squishy, right, as the relative value. But they give $24.73 base case, but worst case, it's $7.09. So this is where things can get wonky. And then best case, of course, is going to be $172. So look at that. So we're going from $7 in the worst to $107 in the best. And this is why these numbers can be all over the place. And there is a comment I read once that said the problem with discounted cash flow analysis is that it's like looking through the Hubble telescope. If you turn it 1 degree in either direction, you're looking at a completely different galaxy. And you can kind of see that here. So I guess you got to figure out what works for you. So fire off an email to Warren Buffett, see if he can teach you what he does, because I would love to know. But yeah, so $24.73 base case, meaning that if this is true, then probably a good time to keep picking up some AT&T. But obviously, that is just projecting out into the future. So yeah, I answered your request. I'm buying that. I'm buying, let's see. You are welcome, man. Ryan Gochenauer. Thank you. Thank you for watching. I really do think it's funny. We got 19 people watching, and I just think it's crazy that people tune in and watch me just chat a little bit about stocks and show what I know, what I don't know, fumble, bumble, and stumble. Yeah, so she said a negative terminal growth rate for something like Apple implies that their margins collapse, their total addressable market shrinks, they begin to cede market share, and they fail to hit on accretive mergers and acquisitions. So Yeah, that's like that. She just laid out the absolute worst case, and I agree. I don't think I can see any of that happening, but stranger things have happened indeed. So, um, thank you for sharing that, Casey. I really do appreciate having you pop on and helping me out when I'm struggling with some things. It's kind of fun. And Dilu says, I sleep calmer. Me too, man. When I have valuable companies in my portfolio, the problem with crypto is that I don't know how much it's worth. Dude, that is exactly it. You don't know how much it's worth. You can't do a discounted cash flow analysis on it or valuation because there's no cash flow. What's it worth? I don't know. That's why Warren doesn't like gold. He's like, hey, it looks nice. You got this shiny yellow hunk of metal sitting there, but what's it doing? Like, it's not doing anything. It's not working for you. It's just, there's my hand. It's just sitting here doing nothing. And yet I still have some. And I've thought of that. And yeah, all I'll say is around 2013, coming out of the last Great Recession, I was really buying into what Dr. Doom was saying. That's all I'll say. If you don't know who Dr. Doom is, and I sold some of my retirement account to buy gold and silver so I could keep it in the house, because when the market crashed and it was obliterated and went to zero, I was going to be sitting pretty. And I will say, if the market goes away, dude, we are going to have so much bigger problems, or we're going to have much bigger problems than trying to barter and trade with gold. It's going to be crazy. But yeah, I do. And you guys know me. I've lost a little bit of money with crypto, with that I have in Celsius. I'm assuming it's gone. I have I don't know, I think like $500 in Ethereum on Coinbase that's just sitting there. Just what the heck money. And I actually was thinking about that. What am I doing with this here? I mean, it's just getting eroded, but I don't know. Casey, brand moat equals pricing power equals margin protection. So the first thing is out. All of Apple's hardware and services use is growing, not shrinking. So the second thing is out. Yeah. I think well said. And it's funny. I kind of like doing that. It kind of made me want to do it more, like push back harder. And yeah, it was a little bit clickbaity on the thumbnail, putting the warning sign in Apple, but come on, you got to grab attention. And the whole point of that is I just wanted people to know that just 52% of their revenue came from one product. Is it sustainable? Probably. Can that get even better? Probably. But it's just something, man. And I know people don't like to do that. And it's something I'm going to try and do more of as I grow in my investing journey, is try to find the worst things, look for the negatives, look for bad things in the company, instead of before only looking for what do I like about this company, but saying like, what don't I like? What are some things to be careful of? What are some things that could go the wrong way? If we hit a recession and people stop buying new phones for a couple of years, I think Apple has so much cash, they're going to be okay. And they'll pivot, because remember, all these companies, again, living, breathing entities. So they have a good management team, great product, as Casey continues to tell us that the market share is being credible. She just doesn't see it being so negative. It can overpower the positives and push total growth under zero. I would agree with that. And Apple averages about one acquisition a month. That's funny. I didn't realize that. I didn't see that yet. Not all of them are accretive, but many are. So the fourth kind of thing, you want to tell everybody, including myself, because I really don't remember what accretive means. I think I have an idea, but if you want to just give us the quick layman, imagine you're trying to explain to somebody who has no college education and kind of does like welding and mechanical work for a living. So this is the danger of trying to model based only on numbers and quant. You need to inject some common sense now and again to keep the models honest. Yeah, it's all going to be on individuals. It's all going to be on people and what you come up with. Let's see. Kevin, his goal is to have 100 shares of Cisco. That's your goal, man. Not advice, but I'd say, I'd buy 1 or 2 a week if you can. Might be something to think about. Let's see. Yeah, so that's her issue with any automated DCF calculators, purely data driven, which sounds like a good thing, but the best models always use adjusted data, not raw data, which is cool. And I'm glad you pointed that out, because I think I did too, saying that was their preset, pre-built numbers, but you can at least adjust it yourself. So I like that it's not set in stone. You can fiddle with the numbers, fiddle with the dials too, and do that. Hey, look at this. Darth, man, I don't know how long you've been on. I just saw it now. I've been yammering and jabber jawing and HPQ and ADP. Okay, guys. So Dilu and Coop, let's do a quick double. Let's see. Yeah, I love it, Darth. Okay, we're gonna do a quick double for you guys. Isn't that what's the double? It's a hamburger, right? Is that Carl's Jr. double? I don't know. All right, so what are we doing? We're doing. Stop it. You distracted me. HPQ and ADP. We will do a Simply Safe and then a DCF valuation for those. It would probably help if I go ahead and share the screen for you guys and bring you along to the land of, I'll just share the window here for a second. Pop that on. All right, so HPQ, or as my friends in Ireland say, HPQ, safety score of 74. Let's just get a quick couple metrics right here. Their dividend growth, 5-year growth streak, and not terribly grow, average 20-year CAGR, but 29% dividend increase last for HPQ. They're paying $1. Looks like we're going to get another raise here in October. So I don't know if they announced it, but it should be coming because they last raised in October of 2021. So they are due. Their next one should be a raise anyway for good old HPQ. Dividend yield is 5% above the 5-year average. PE pretty much in line. And their 52-week range kind of, smack dab in the middle. And free cash flow payout ratio only 22%. And are they buying back shares? Like gangbusters, they are. $1.97 billion in 2012 at $1.8 billion right now. And their sales have been flattish. So that's HPQ there. And let's see what they're get for a stock run-of-the-mill discounted cash flow. Their intrinsic value base case, $42.43. So they're about 28% undervalued right now. And the $43. So interesting that we get a discounted cash flow base case of, let's see what that is. Because I think it's a 0% terminal growth rate. So just, what do you think of this discount rate, Casey? 9.39%. What do you use, and how many periods do you go up? And also on this, so we have the equity model via FCFE. I think that's what, free cash flow to, I don't know, equity. I shouldn't even say, but there's different ones. So you can really change the models on yourself. Change the models on yourself. Okay, so I would say about $43.12. So, hey, that might be an interesting one to look at. And the worst case, $26 on the DCF. And then last was, I forgot it already. Sorry. You're going to have to watch me do this, fumble around. Oh, ADP. Okay. Sorry, you guys don't mind, right, that are still watching? Dude, the time flies. This is just... Someday I'll just do this. Why don't we I'll do like a 10-hour just sitting here until somebody will have to, like, hey, you fell asleep. You guys can watch me sleep. Okay, ADP, 97, very safe dividend safety score, only a 2% yield, but let's see how they've been growing it. How are they getting on? 20% dividend increase just happened. I did tweet about that. 20%, 12% 20-year CAGR. 47 years of uninterrupted dividends and 47 years of dividend growth. $5 a share they're paying. So they did just very nice, healthy raise. And the timeliness is exactly in line with the 5-year average, but the PE still 30, a little bit high. And they are toward the high end of the 52-week price range. Free cash flow payout ratio, 55%. So that's not too terrible. And it's actually come down from recent years. Plenty of free cash flow per share to cover that dividend. You guys realize I haven't drank anything this whole time? I forgot to bring myself some water. Shares outstanding, not terrible. From 487 million in 2013 to 419 million, and sales has been going up and to the right. So ADP looking good there. And let's see, old ADP, what do we get for a intrinsic valuation from Alpha Spread? $175.01. So they are saying in a base case, it's about 30% overvalued. And the discounted cash flow is 117. So it's about 53% overvalued on discounted cash flow for that. But let's see some Wall Street estimates. I'm curious what these analysts are throwing out there. Oh, interesting. So the lowest forecast, dude, I must have a slow internet connection, is $215 is the lowest forecast, but average 2% upside. So there you go. You might want to wait a minute to buy yourself some ADP. There we are. Hey, okay, so that's that. Oh, yeah. Oh, yeah. It looks like Göteborg, but I remember I asked somebody once who had been to Sweden, and they said it was either Eterborg, or something like that. Yeah, look at this, Darth. Dude, I'd bring you on, but I'm going to hop off this in a few minutes. So Pepsi's going to suck up more companies. Dude, you just get like a big vacuum. I'm just thinking of Pepsi sucking up companies. I love it. Oh, Kevin, thanks. I hit those shares of Pepsi a while ago now. But I'll take it. And now I'm getting paid dividends every, Dividend King, what's up, man? Hey, I haven't seen you around these parts in a while. And let's be real. The only way T can get to 107 is if they do a couple reverse stock splits and probably cure cancer on top of that. Then I think we might see them getting there. But yeah, it's just kind of funny. You can see how it's almost nonsensical to even use a best case, I think. But I'm learning. Here we go. On my Hubble example, DCF, refuse to forecast out 5 years. Oh, cool. That's a little Cartman. Do 1 year, 2 year, and 3 year. Yeah, again, it's crazy. It's just something I'm learning. And again, you may never watch this. I am going to remember that $96 Procter & Gamble, or was it 108? I think it was 96. It may never get there ever again, unless they do a split, So yeah, it's funny that you point that out, because I was just thinking that it's like, yeah, here, and like Darth says, it's a T-bone steak. Yeah. So I like it to be like, that's interesting. But again, like we've said ad nauseum, nobody knows what's going to happen in the future. But even Warren, dude, Warren and Munger together, like the Galaxy Brains. What's Galaxy Brain? Is that an account on Twitter? I'm going to call Warren Galaxy Brain. I probably just pissed somebody off by doing that. But yeah, just the two of them together have made mistakes. So it just is why it's so great. Nobody knows exactly what's going to happen. And let's see. Oh, could the iPhone be the new BlackBerry? Yeah, I don't think so. And again, I kind of got I would like to say excoriated, because it sounds more interesting on Twitter. But yeah, they didn't have the ecosystem that Apple does. They didn't have the BlackBerry stores. They didn't have this cult following around BlackBerry. So yeah, thing with Apple, it's unlikely. So Alpha doesn't pay much yield, right? And that's one of my problems of under 100. I probably will start picking it up, and I was hoping it would get there. And then KC, it's hard for create a hypothetical. Hey, this is also, if you don't know, like, this is why it's great, because she won't come on, which is fine, but it just is nice to have KC pop in and give her very smart, educated opinions. I really do enjoy it. Create a hypothetical where she needs a stock to fulfill a role in her portfolio, and Apple is the answer. Yeah, here we go. My creative. We get more money back over some time frame, then we get to spend it. Thank you. that really does help a lot. So accretive means we're getting more money back over some time frame. Cool. Kevin's buying a new iPhone every 10 years. Thank you for that real-time market research. Now let's see, Casey. I'm going to run through these really quick. With a HPQ, PC demand is running on a negative 20% year-over-year comp, and most industry analysts don't see that. Yeah, and the companies too, because I know that Intel mentioned that as well. Discount rate's different for every company. Interesting. Yeah, it takes time. It really does take some time to do the DCF analysis. And yeah, okay, a lot of stuff. Then she works forward from anticipated capital outlays. Okay. So I should read that. Work forward from anticipated capital outlays and assume rationality on the part of the CFO in selecting the least expensive form of available capital at each step in the model. Yeah, it gets pretty okay. And this was the last thing I wanted to know. For the risk-free rate, she uses the higher of the 2 versus the 10 and the average of the last 2 years of market performance for equity premium. That's very cool. I like that. And yeah, I know the bonds, the risk-free rate, it's truly never risk-free. I mean, I guess it's the default, the government defaulting is highly unlikely, but obviously with inflation going up, that's going to inverse, the bond yields will move lower when inflation rises, right? So there's risk of your money being locked up there and losing. So yeah, I mean, it's just a different kind of risk anyway. So all right, well, I think I'll end it there. I can't, that hour flew by. Speaking of flying by, I did a should I play Pee-wee? I did an interview yesterday with my new friend Marcus from Trading with a Dummy YouTube channel. I had never talked to him before, and he wanted to do like a 30 to 40-minute interview, and it went an hour and 45 minutes. So I don't know who's going to be sticking around watching that thing for that long, but you know, hey, I don't hope this isn't too loud. All right, that's something I got to figure out. I wasn't on screen and I was talking for that. So I think in the future, because I don't know why it won't put my voice on when that's playing. It would be nice to do a reaction video like Elon Musk carrying the kitchen sink or something, but that's something we're going to work on here on the channel. And I think I am going to just play that as I'm completely done. Let's do it now. That's the new habit. Here we go. So I do thank all of you for stopping by. I got to get out of here. And if you come back next week, I will be here with some other topic to talk to. So thanks for stopping by. So
Thank you.